Financial statements are the standardized reports that communicate the financial health of a business. They act as the universal language for stakeholders to evaluate performance. To ensure accuracy, these reports follow a specific logical sequence. We begin with the income statement, which measures financial performance over a specific period. Next, the data flows into the Statement of Owner's Equity, which explains how the owner's interest in the business has changed. Finally, the balance sheet presents the company's financial position at a single point in time, completing the cycle. By following this rigid order, we guarantee that information is accurately reconciled across all documents. This is the foundation of professional accounting. Think of financial accounting as baking a perfect cake. The foundation of this process lies in its ingredients, which we call the accounting elements. The accounting cycle is your recipe. It defines the specific steps and timing required to process these raw ingredients into reliable financial data. Finally, the finished product is your set of financial statements. Just as a cake represents the combination of all ingredients following the recipe, these statements represent the financial reality of the business. By mastering this relationship, you ensure that every financial report tells an accurate and meaningful story about the organization's performance and position. Accountants classify all business transactions into 10 foundational elements. These represent the essential building blocks for all financial reporting. First, we identify the three elements that define a firm's financial position: assets, liabilities, and equity. Next, we look at the four elements that describe financial performance over a period: revenue and gains, contrasted against expenses and losses. Finally, we account for movements in capital and comprehensive income, investments by owners, distributions to owners, and comprehensive income. These 10 elements work together in an integrated ecosystem to tell the story of a company's financial health. To understand the process of preparing financial statements, we will follow Cheesy Chuck's Classic Corn, a new gourmet popcorn startup. We will use their June trial balance data to construct the three core financial statements step by step. This raw information serves as the foundation for everything we build. By systematically applying accounting rules, we transform this data into meaningful reports on performance and financial position. For Cheesy Chuck's, we begin by listing our total revenue for the month of June, which amounts to $85,000. Next, we aggregate all operating expenses incurred during the same period, totaling $79,200. By subtracting these operating expenses from our total revenue, we derive the net income. The result is a net income of $5,800, marking the business's profitable performance for June. Professional accounting requires adherence to standardized formatting conventions to ensure clarity and comparability. We utilize a precise three-column layout. The first column serves to categorize our accounts, such as revenue and expenses. The second column is dedicated to itemized totals and interim calculations. These allow stakeholders to understand the composition of our primary categories. Subtotals are distinguished by a single underline, signaling a momentary summary of the financial data. Finally, the third column presents our definitive calculations. Here, we identify the net income figure, which is emphasized with a double underline to denote the completion of the performance reporting cycle. The Statement of Owner's Equity acts as a vital bridge between the income statement and the balance sheet. It tracks the owner's claim on the business over a period of time. We start with the beginning balance, add new capital investments, and the net income generated this month, then subtract any drawings. The resulting ending balance is the amount reported on the balance sheet. The Statement of Owner's Equity tracks the financial changes to the owner's stake in the business. Since Cheesy Chuck's is a new sole proprietorship, our beginning balance is $0. We add the initial investment of $12,500 and the net income of $5,800 from our income statement. Next, we subtract personal withdrawals of $1,450. This brings us to an ending equity balance of $16,850. The balance sheet provides a vital snapshot of a company's financial position at a specific point in time, specifically June 30th. Unlike the income statement, which covers a period, the balance sheet tells us exactly what the business owns and owes on this date. At the heart of the balance sheet is the fundamental accounting equation: assets equal liabilities plus owner's equity. This equation must always remain in balance, acting as a scale for the company's financial health. Assets represent the economic resources the company owns. Liabilities are the obligations owed to outside creditors. Equity represents the owner's residual claim, essentially what remains for the owners after all liabilities are satisfied. By reporting these elements in equilibrium, the balance sheet confirms that every asset is financed by either borrowing from creditors or through investment by the owners. A balance sheet reports the financial position of a business at a specific point in time. It primarily categorizes elements into what the business owns, known as assets, and what it owes, known as liabilities. For Cheesy Chuck's, assets include cash of $6,200 and equipment valued at $12,500. These items represent the economic resources the business controls, totaling $18,700. Conversely, liabilities represent financial obligations. Cheesy Chuck's owes $650 in accounts payable and $1,200 in wages payable, resulting in total liabilities of $1,850. These two categories form the foundation of the balance sheet, reflecting the core distinction between resources held and debts incurred. To ensure our balance sheet is accurate, we must satisfy the fundamental accounting equation. Assets must equal the sum of liabilities and equity. Our total assets for Cheesy Chuck's amount to $18,700. On the right side, we combine our liabilities of $1,850 with our equity of $16,850. When we add these two figures, we reach $18,700. Since this matches our asset total, the equation is satisfied and the balance sheet is verified. Financial statements form an integrated ecosystem where data flows sequentially. They are not independent documents, but rather links in a critical chain. The process begins with the income statement. The calculated net income is a vital input for the statement of owner's equity. Subsequently, the ending balance from the equity statement determines the equity component of the balance sheet, ensuring the accounting equation remains balanced. This interdependence means that an error in the initial income statement flows through the entire system. It forces a failure in the final balance sheet reconciliation. Consequently, precision at every stage is mandatory. The integrity of your financial reporting depends on maintaining this rigorous standard of accuracy. Materiality is a fundamental accounting principle defined by the significance of an amount. It is not an absolute threshold, but a relative one. An error that is critical for one firm may be inconsequential for another. Consider a discrepancy of $1,000. For a local business like Cheesy Chuck's, this amount could represent a significant portion of monthly profit, making it highly material. However, for a global giant, the same amount is immaterial, as it would not change the overall picture for investors. Accountants must always exercise professional judgment. Context is essential, as the same figure carries different weight depending on the scale of the entity being evaluated. Liquidity is defined as a business's capacity to convert its assets into cash to satisfy short-term financial obligations promptly. To analyze this, we calculate working capital. It is determined by subtracting current liabilities from current assets. Current assets are those expected to be converted to cash within a year, while current liabilities are obligations due within that same period. A positive working capital result indicates that the firm possesses healthy financial flexibility to cover its debts and invest in operations. The current ratio is a critical liquidity metric that evaluates a company's ability to cover its short-term obligations. It is calculated by dividing current assets by current liabilities. This ratio allows for meaningful comparisons between companies of different sizes, solving the problem of materiality. By normalizing data, We can evaluate relative financial health regardless of the company's total scale. For Cheesy Chucks, we observe a current ratio of 3.35. This means that for every dollar of current liabilities, the business holds $3.35 in liquid current assets. This indicates robust short-term financial health as the business is well positioned to meet its upcoming debts without strain. Ethical reporting is the cornerstone of the accounting profession. Integrity in financial documentation is not just a regulatory requirement. It is the bedrock of market trust. The case of Waste Management, Inc. serves as a stark warning. Manipulating expenses or artificially deferring costs to inflate earnings is fraudulent. Such practices do not create value. They destroy stakeholder trust. Accountants hold a professional duty to report truthfully. By upholding high ethical standards, you protect investors, employees, and the public, thereby maintaining the stability of our global markets. In the global business environment, two primary accounting frameworks dominate: US GAAP and IFRS. Despite their jurisdictional differences, both rely on the same 10 fundamental accounting elements to construct their financial statements. However, classification nuances persist. A notable example involves assets held for sale. IFRS mandates that these assets be reclassified as current assets once they are available for disposal. US GAAP offers more flexibility, which can lead to meaningful differences in liquidity ratios. These structural variations influence the placement of accounts within financial statements. For modern accountants, recognizing how different standards affect the numerator or denominator of key financial ratios is a critical competency for global business analysis. In our interconnected global economy, businesses operate across borders, making the consistency of financial reporting essential. Two primary frameworks dominate the landscape: US GAAP and International Financial Reporting Standards, or IFRS. While they share core elements, their nuances can lead to significant differences in financial statements. For an accountant, interpreting these differences is critical. A ratio calculated under one standard might not directly equate to the same ratio under another. To conduct meaningful analysis, professionals must adjust for these variations. Only by accounting for these structural nuances can we ensure a true apples-to-apples comparison. Ultimately, global standards require professional judgment and deep analytical rigor to provide an accurate picture of financial health. While manual preparation remains the most effective pedagogical method to learn the fundamental accounting cycle, the professional landscape is shifting. Today, technology is increasingly automating the recording process. This transition signifies more than just efficiency. It marks a fundamental change in the accountant's role. The modern accountant's role is evolving from manual data maintenance to interpreting the story that financial statements tell through data analytics. This shift enables accountants to act as strategic partners, providing insights that drive organizational success. The financial cycle is an interconnected ecosystem of reporting. We begin with the trial balance, our summary of raw account data. Next, we construct the income statement to measure our financial performance over the period. Net income from the performance statement flows directly into the statement of owner's equity, tracking changes in the business value. Finally, the ending equity updates our balance sheet, confirming our financial position and ensuring the equation remains balanced. This sequence is foundational. Each report relies on the accuracy of the one preceding it, forming the complete integrated story of a company's financial health. Mastering these three statements is just the beginning. By understanding how accounting elements flow through these reports, you gain the power to make informed business decisions. This flow is the backbone of organizational success, enabling you to contribute to the ethical and financial health of any entity. Looking ahead, the practice of accounting is evolving. While the foundational principles remain, digital transformation is shifting the focus toward advanced data analytics. Your role will move beyond rote preparation toward interpreting the narrative hidden within the numbers. By grounding your practice in ethics and precision, you will lead with insight.